It might have flown under the radar for some, but there was a pretty significant move recently in the Senate.
Oh, yeah? What was that?
A 66-32 procedural vote. It's pushing the Genius Act forward for debate.
Ah, the Genius Act. Right. That is a major step, especially for stablecoin regulation here in the U.S.
Definitely. And it's kind of interesting timing, considering the earlier roadblocks.
You mean the Democratic concerns about potential conflicts?
Exactly. Relating back to the previous administration's sort of crypto dealings.
Well, that procedural vote really does signal a shift, I think. It suggests that, despite maybe some sticking points remaining, there's a growing feeling in the Senate that a framework for stablecoins isn't just like nice to have, but really essential now.
Absolutely. So for this deep dive, we are plunging right into the Genius Act.
Guiding and Establishing National Innovation for U.S. Stablecoins Act, quite a name.
It is, and we've got a fascinating mix of sources you shared. Groups like Public Citizen, Americans for Financial Reform, they're raising some serious caution flags.
Definitely some strong opposition there.
But then you have perspectives from, say, Ackerman Associates or Galaxy, more optimistic. And Cointelegraph is watching the legislative side closely.
A good range of views.
So our mission today is really to get under the hood of this thing, understand what it's trying to do, the key debates, and what it might actually mean.
Especially for big tech and the crypto market generally.
Yeah. What kind of ripples could this cause?
It's definitely pivotal. I mean, stablecoins could really reshape payments, how finance works. So understanding this proposed regulation is vital.
Okay, let's unpack it then. The Genius Act. Introduced back in February 2025.
That's right, February 4th. Bipartisan group, Haggerty, Scott, Gillibrand, Loomis.
So at its heart, what's the big idea? What are they aiming for?
Fundamentally, it's about creating a clear rule book, a legal framework for stablecoins in the U.S.
Okay.
The main goal is sort of twofold. First, just formally allow stablecoins for payments, integrate them properly.
Makes sense.
And second, more strategically, it's about helping the U.S. dollar stay dominant in international payments, especially as this whole digital asset space grows globally.
And it seemed like it got some early support, the Senate Banking Committee.
Yes, exactly. On March 17th, a revised version got bipartisan approval from the committee. 18-6 vote.
That's pretty solid cross-party agreement initially.
It showed it had real momentum, yeah.
No, the oversight part, this sounds interesting. A mix of federal and state. How does that work?
Right. It's a dual system, basically based on size.
Size of the issuer.
Yeah. If you're big, over $10 billion in market cap.
So total value of your coins out there.
Exactly. Then you're regulated federally. Fed and the OCC, Office of the Controller of the Currency.
Okay. And the smaller guys, below $10 billion.
They can be regulated at the state level, but, and this is key, the state rules have to be pretty much the same as the federal ones. Yeah. Substantially similar is the term they use.
Got it. So there are some baseline rules everyone has to follow, big or small. What are those core requirements? The absolute must-haves.
Yeah, there's a core set focused on stability, consumer protection. First off, full one-to-one backing.
Meaning?
Every stablecoin has to be backed by an equal amount of reserves. U.S. dollars or other really safe liquid stuff.
Like what?
Think short-term U.S. treasuries, deposits at central banks, or qualified repos or repurchase agreements, very safe short-term collateralized loans, basically.
Okay, solid backing. What else?
Second, segregation. Those reserves, totally separate from the issuer's own operating money.
No mixing funds.
Absolutely not. That's crucial.
Seems vital for transparency, accountability. What's next on the checklist?
Well, transparency and accountability are big themes. Monthly certifications on reserves, regular audits by registered accounting firms.
Makes sense. More frequent for the big players, I assume.
Likely, yes. Then there's a huge focus on stopping illicit finance, AML.
Anti-money laundering.
Right. Strict compliance with U.S. AML and sanctions rules the Bank Secrecy Act stuff.
So KYC, monitoring.
Exactly. AML-CIP programs, monitoring and reporting suspicious activity, keeping records, enhanced due diligence where needed. It's pretty comprehensive.
Sounds like a robust framework they're building.
They're aiming for it. There's even a rule that company officers have to personally certify AML compliance each year.
With penalties if they lie.
Yep, penalties for false certification. Plus, public disclosure, they have to publish reserve details, redemption policies.
Okay. And what if an issuer goes bust? What happens to the people holding the stablecoins?
That's a critical piece. Stablecoin holders get first dibs on the reserves. The reserves are meant to be legally protected, separate from the issuer's other assets in a bankruptcy.
Bankruptcy remote, they call it.
That's the term, like a legal firewall around those reserves, protecting the holders.
What about earning yield? You see some stablecoins offering interest. How does the act handle that?
It explicitly bans it. Issuers cannot offer yield or interest on the stablecoins they issue.
Reinforces the idea they're for payments, not investments. And to really nail that down, the bill clarifies their legal status, doesn't it?
It does. Very clearly says payment stablecoins are not securities, not commodities, not investment companies under federal law.
That provides some much-needed certainty for the industry, I bet.
They've definitely been asking for that clarity.
One last thing on the what.
Yeah.
What about existing stablecoins? If this passes, do providers just have to drop non-compliant ones overnight?
No, there's a grace period. 3 years.
Okay.
Gives exchanges, wallet providers, time to stop supporting stablecoins from issuers who haven't gotten the green light under the new act. It's a transition period, basically.
Okay, that paints a pretty clear picture of the act's structure and goals. But, like we mentioned, it hasn't exactly been smooth sailing.
Far from it.
Let's get into the controversies. Public Citizen has been really vocal, right?
Oh, absolutely. Very strong opposition. Their core argument is that this bill basically legitimizes what they see as risky crypto schemes.
And opens the door to more abuse.
Yeah, they worry it could mean more market manipulation, more coin failures, more use for illicit finance.
I remember their letter to the Senate Banking Committee, pretty blunt, said it would add a sheen of government legitimacy to something potentially harmful.
That sums up their view well, and a huge part of their objection is what isn't in the bill.
Meaning?
The lack of Bank Holding Company Act provisions. They see that as a massive loophole.
Allowing big commercial firms, they mentioned Amazon, Walmart, Meta.
Right, allowing them to effectively get into banking via stablecoins, but without the usual rules that keep banking and commerce separate.
Bartlett Naylor called it ill-conceived, incomplete, and threatening. Pretty strong words.
Underscores that deep concern about blurring those lines.
And it wasn't just Public Citizen ringing alarm bells, was it? There was a coalition of other groups, too.
Yes, over 20 organizations, including Americans for Financial Reform, signed a letter echoing a lot of the same point.
Calling it a crypto industry wish list?
Exactly. They felt both the Genius Act and the House version, the Stable Act, were weak on consumer protection, had flawed rules for reserves, bankruptcy, custody, just not strong enough.
What was their absolute biggest worry?
Very similar to Public Citizen, these huge non-financial companies becoming stablecoin issuers without, in their view, proper oversight.
The risk being?
Well, these companies already have enormous market power, access to tons of data. The worry is they get even more power, more data, and if one of them hits trouble,
it could ripple through the whole economy.
Precisely. Massive systemic risk. Mark Hayes from AFR specifically warned about, tech billionaires creating private money with weak oversight. Drew parallels to the pushback Meta's Libra got.
Right, I remember that. The American Economic Liberties Project also weighed in heavily on this big tech angle, didn't they?
They did. Their central argument is that the Genius Act basically lets big tech control money.
How so?
They see a pathway where tech giants buy up non-bank stablecoin issuers, slide into banking, get access to all that juicy financial data.
And monetize it, potentially.
Yeah, monetize it, maybe even benefit from government backstops meant for traditional banks. It really centers on this erosion of the separation of banking and commerce.
Going back to the Bank Holding Company Act of '56, why was that separation so important historically, according to them?
AELP argues it wasn't just about financial stability, but also fair competition, preventing too much economic power in too few hands.
And the fear is the Genius Act undoes that.
Or at least reopens that can of worms in the digital age where data is power. They talk about excessive power concentration, conflicts of interest, systemic risks spilling over from the commercial side to the financial side.
And the surveillance aspect, too.
Huge concern. They reference Rohit Chopra's warnings about big tech's incentive to track everything you buy, potential for espionage, tracking, even censorship.
Wow.
They draw parallels to Alipay and WeChat Pay in China and the regulatory reaction there. And again, back to Libra, the idea of, as someone put it, the people who rick your data off now getting into your wallet.
And it wasn't just advocacy groups nervous. Even some Senate Democrats got cold feet near the end, right?
Yeah.
Before that procedural vote.
Yes. That's crucial. Despite that earlier committee vote, some Democratic support definitely softened.
Why? What were their specific worries?
Mostly around rules for foreign issuers, national security stuff, and whether the AML provisions were really strong enough. Senator Warner saying the text not being finished kind of captured that unease.
So even after revisions, some weren't fully on board.
Right. 9 Democrats put out a statement with ongoing reservations. They wanted stronger AML, better rules for foreign issuers, national security safeguards, financial system safety, accountability. Still felt it needed more work.
Added a lot of uncertainty right before the vote.
Definitely.
Okay, one more area of concern before we flip to the potential upsides. DeFi, decentralized finance. What's the worry there?
The concern is that the act, as written, could really hit DeFi hard.
How?
Specifically, the part treating yield-bearing stablecoins as securities, that puts them under the SEC.
Which likely means
Delistings. US-based decentralized exchanges would probably drop them. Centralized ones almost certainly would. Liquidity in USD pools could dry up fast.
and protocols might block US users.
Could happen, yeah, to avoid trouble. Plus, there's the systemic risk if major stablecoins used widely as collateral in DeFi suddenly face collapse or severe restrictions. It could cascade.
Okay, so a lot of potential pitfalls highlighted there. Let's pivot now. What about the arguments for the bill? The potential benefits? Ackerman Associates seem pretty positive.
They did. They see the Genius Act as a really key step towards getting that comprehensive regulation stablecoins need in the U.S.
Essential for the future of digital currency, they argued.
Yes, while also protecting consumers and keeping the financial system stable. They really emphasize the goal of keeping the U.S. leading in financial innovation while tackling those valid concerns about manipulation, fraud, consumer protection.
And they liked the specific provisions.
Yeah, they highlighted the segregated 1.1 reserves, the strong AML rules, the audits, and especially that clarification that payment stablecoins aren't securities.
What about Galaxy? They're a big name in crypto. Their take?
Galaxy also sees it quite positively. They think it creates a strong, effective regulatory system.
Good for innovation.
They believe so, yes. Good for innovation and also good for the dollar's global reach. They stress that it brings clarity to this legal gray area where stablecoins have been operating without clear federal rules.
And the specifics they pointed to.
The clear paths for becoming a permitted issuer, federal or state qualified. The 3-year grace period. Define roles for regulators. The requirements for foreign issuers, too, needing comparable rules, registration, complying with U.S. orders, potential reciprocity.
So setting standards for everyone.
Right. They also noted the ban on yield, the tough AML and reserve rules, the insolvency protections for holders, and the consumer protection measures.
So overall, Galaxy sees the revised bill as
stricter than earlier versions, but ultimately a win. A win for crypto, for traditional finance, and for U.S. geopolitical interests because it creates that regulated pathway, protects the system, and promotes the dollar.
How is the general news coverage, like Cointelegraph, framed it?
Cointelegraph has mainly tracked the legislative journey. They reported the procedural vote success, the earlier Democratic pushback, the revisions made to get bipartisan support.
Is the facts mostly.
Pretty much, highlighting the key requirements, full backing, audits, regulatory approval, the restrictions on algorithmic stablecoins. They also noted Senator Loomis hoping for passage by Memorial Day.
Okay, so we have the internal U.S. debate. Let's zoom out. How does this compare globally? Like the EU's MiCA framework.
Good comparison. They both aim to regulate digital assets, but they're different beasts.
How so?
MiCA is way broader, covers all sorts of crypto assets. Genius is laser-focused on payment stablecoins.
What about reserves?
Different there, too. MiCA doesn't absolutely require 1.1 reserves like Genius does, and they treat algorithmic stablecoins and CBDCs differently.
Central bank digital currencies.
Right. Genius excludes CBDCs, wants more study on algorithmics. MiCA regulates stablecoins and ART's asset reference tokens, bans unbacked algorithmics, and also leaves CBDCs out of its scope for now.
Interesting political contrast, too, with Trump opposing a U.S. CBDC but supporting private stablecoins, while Europe explores a digital euro.
Yeah, very different philosophies emerging there.
What about the global impact? If Genius passes, could it set a standard?
It absolutely could. If the U.S. enacts this, it could position the U.S. as a leader in stablecoin rules.
Influencing other countries?
Potentially, yeah. It might influence international standards, encourage more cross-border cooperation on oversight. Everyone's watching what the U.S. does here.
And looking ahead, whatever the final version looks like, how will issuers have to adapt?
Well, they'll definitely need to look hard at their business models, their reserve portfolios.
To make sure they comply.
Exactly. Probably means holding more actual U.S. dollars, more short-term treasuries, those super safe assets.
Could be challenging initially.
Maybe some short-term hurdles, yeah. But the long-term idea is a more transparent, secure market that could build trust, lead to wider adoption.
Okay, let's try and wrap this up.
Yeah.
What are the absolute core takeaways from this deep dive on the Genius Act?
Okay, first, it's a major U.S. effort to regulate stablecoins, aiming to legitimize them for payments and keep the dollar strong globally.
Right.
Second, key rules involve full reserve backing, state-federal licensing based on size, and strong AML compliance.
But third,
big controversies remain. Consumer groups, some lawmakers, worry about financial stability, consumer protection, and especially letting big tech mix commerce and banking.
while the industry, fourth point, is generally hopeful, it brings needed clarity, even with stricter rules.
Pretty much sums it up, a complex balancing act.
And for you, listening, why does this matter? Why track this legislative stuff?
Because this could really change how the financial system works down the line. It might affect how you use digital assets, what role big tech plays in your finances.
And it's not a done deal yet.
Not at all. That procedural vote was just one step. The debate continues, the outcome is still uncertain, but it's shaping the future of digital money, the tools you might use.
So here's a final thought, something for you to chew on. As tech and finance keep merging faster and faster, what do you think are the most vital guardrails we need?
Yeah, how do we protect both innovation and stability in this new digital age?
Should big non-financial companies with all their data and reach be allowed to issue things like stablecoins? And what might that mean long-term for your privacy and for where economic power ends up?